Welcome back to Talk Tickers. You are tuning into a special edition of our deep dive today.
Yeah, glad you could join us for this one.
So our mission today is pretty straightforward. We are breaking down the latest Q1 2026 earnings call for American Eagle Outfitters.
Ticker AEO for those following along.
Right, AEO. And for the retail investor out there, the goal here is to just cut right through the corporate fluff, deliver the hard data, and give you a clear, actionable verdict.
Exactly. And, today's focus is really about finding the actual signal in the noise of mall retail earnings. Because there's a lot of noise.
There's so much noise. But if you look at this Q1 2026 earnings print, and if you basically blindfold yourself to the company name at the top of the spreadsheet.
Which is hard to do, I know.
Right, but if you do, you'd swear you were looking at a mid-cap SaaS company that just successfully pivoted its pricing model.
Yeah, you are definitely not thinking about a legacy mall retailer selling, denim and hoodies.
Not at all. I mean, you look at the headline numbers. You see consolidated revenue hitting $1.2 billion. That's up 10% year over year.
Yeah.
You see an operating income of $28 million that outright beat their own internal guidance. And you see EPS landing at 14 cents.
Pretty solid.
It's very solid. But honestly, none of that is the real headline here. The absolute jaw dropper on this print is that gross margin expanded by 860 basis points to hit 38.2%.
It's just wild.
Right. A mall retailer expanding margins by almost 9 full percentage points in a single 12-month cycle in this macroeconomy. I mean, it basically defies every gravity-bound law of physical retail.
It really does. It completely shatters the current narrative around consumer discretionary spending right now.
Totally.
Because, the prevailing consensus on Wall Street is that the consumer is just exhausted, wallets are clamped shut, and retailers are going to have to race to the bottom on price just to clear the racks.
Right. Heavy discounting.
Exactly.
Yeah.
But AEO's Q1 print is just this violent rejection of that entire thesis.
Okay, let's unpack this, because I want to know how a mall retailer manages to skyrocket their margins like that.
Well, you really have to isolate the mechanics of that 860 basis point jump, because it's not just one singular achievement.
Okay.
It's actually a collision of a massive accounting normalization and, frankly, a pretty brutal, deliberate shift in their commercial strategy. So we really need to tear down the wall between those two things.
Yeah. Let's start with the accounting normalization first, because I want to make sure we aren't grading them on a curve here.
Start off.
So Mike Mathias, the CFO, he stated that merchandise margin alone improved 710 basis points, primarily due to lapping last year's inventory write-down.
Yep.
So I look at that and I think, okay, part of this quote-unquote miracle margin expansion is really just the mathematical benefit of not repeating a total operational disaster from last year.
Right. That is the cynical read. And honestly, it is partially accurate.
Yeah.
When you lap a write-down of that magnitude, your year-over-year comparables are going to look artificially heroic.
Because last year they were just sitting on a mountain of liability inventory.
Exactly. Styles that totally missed the mark, wrong fits, wrong colors. And when a retailer have to flush the pipes like that, they aren't just selling at a discount. No. They're basically taking a machete to the balance sheet. They mark the inventory down to its net realizable value before it even hits the clearance rack.
Which just decimates your gross margin.
Right. It crushed them in Q1 of last year. So, yes, stepping over a remarkably low bar accounts for a really large chunk of that 710 basis point leap.
Right.
But, and this is crucial, if you just write it off as an accounting quirk, you completely miss the structural change happening underneath it.
Because they didn't just normalize the inventory. They totally changed how they value the inventory that is actually moving.
Yeah.
And this is where I really want to push on that strategic shift, because management made it very clear on the call that they have actively pulled the plug on those site-wide, brand-wide promotions.
Yeah, no more blanket discounts.
Exactly. The days of the 40% off everything in the store email blasts seem to be over. But I struggle with the risk profile of that decision, to be honest.
Why is that?
Well, in an environment where the consumer is actively hunting for value right now, abruptly ending your site-wide discounts feels like a fantastic way to just crater your store traffic.
Oh, it is an incredibly high-wire act. And we've seen other legacy retailers attempt it and just completely paralyze their top line.
Because they train their customers to wait for the sale.
Exactly. That's the trap legacy retail falls into. You train your customer base over an entire decade to literally never pay full price. The customer learns, oh, Tuesday's 30% off, but if I just wait until Memorial Day, it'll be 50% off.
Right. You build a customer file addicted to the promotional drug.
You do.
Yeah.
And breaking that addiction usually requires a massive hit to your revenue in the short term. But what makes AEO's quarter so anomalous is that they implemented these, quote, disciplined high-margin commercial strategies and still grew consolidated comps by 8%. Yeah, they held the line on price and the customers still converted.
So walk me through the actual mechanics of that execution.
Yeah.
Because disciplined commercial strategies, I mean, that's just sanitized corporate speak. It looks great on a slide deck.
Yeah, for sure.
But how does that actually manifest on the floor of an American Eagle or an Aerie store for you as a shopper?
Well, it basically manifests through surgical precision in merchandising rather than using a blunt force sledgehammer.
Okay.
So instead of a blanket discount, they're using highly targeted item level promotions. If a specific colorway of a seasonal top isn't moving, they mark down that specific SKU to clear it.
Yeah.
But they heavily protect the core denim or the core intimates.
Got it.
And more importantly, they instituted what they call always-on pricing in their key staple categories.
Which is a huge psychological pivot.
Exactly. You set a fair, everyday average unit retail, or AUR, that the customer can trust won't just arbitrarily drop by half next week. When you stabilize the AUR across your core non-seasonal items, the customer actually feels way more confident transacting today rather than holding out.
I see the logic there.
Yeah.
Like if I know the core black leggings are always going to be $40, I just buy them when I need them. I don't try to game the system.
Exactly.
And if they are driving up that AUR without a corresponding spike in the cost of goods sold, I mean, that just flows directly to the gross profit line.
Yep.
Their gross profit dollars rose 41% to $456 million.
Yeah.
That is pure operational leverage right there.
And that leverage isn't even just coming from the merchandise margin. We have to look at the BOW expenses too.
Right, the buying, occupancy, and warehousing costs.
Yeah, they leverage BOW by 150 basis points. Because when your consolidated revenue jumps 10%, but your fixed costs, like your store leases, your corporate overhead, your distribution centers, when those stay relatively flat, you get this massive flow through to the bottom line.
Which actually brings up a huge structural catalyst they just brought online.
Oh, the new distribution center.
Yeah. They opened a brand new West Coast distribution center in Phoenix in early May. And apparently, they stood this entire thing up in under a year.
Which is incredibly fast.
Right. From a supply chain perspective, the speed of that deployment is staggering. But the financial implications of internalizing that logistics footprint, that seems even bigger. They are actively winding down their reliance on third-party fulfillment operations.
Yeah, that shift from a 3PL to own distribution is a really critical maturation point for a retailer operating at this massive scale.
How so?
Well, when you rely on third-party logistics nodes, especially on a regional edge like the West Coast, your variable costs are highly exposed to vendor rate hikes. And more importantly, you lose granular control over the customer experience.
Right, you're at their mercy.
Totally. So by bringing the Phoenix DC in-house, they aren't just cutting the middleman margin out of their fulfillment costs. They are dramatically compressing the time to inbox for their entire West Coast customer base.
Which directly impacts conversion. Because if a customer in California sees a 3-day shipping window instead of like a 7-day window, the cart abandonment rate is going to drop.
Exactly.
It's an operational efficiency that acts as a stealth top-line driver.
Precisely. And it also changes how they manage their inventory allocation.
Right.
When you control the node, you can dynamically balance your SKUs between the East Coast and West Coast based on real-time sell-through data. You aren't locked into these static allocations at a 3PL.
Makes sense.
So that BOW leverage we saw this quarter, that is likely just the initial phase. As that Phoenix facility fully ramps up and optimizes, the actual cost per package shipped should drop materially over the next 4 quarters.
Okay, so the aggregate numbers paint this picture of a retailer that has completely optimized its pricing architecture, they've fixed their inventory bloat, and they are executing an absolute masterclass in supply chain efficiency.
On the surface, yes.
Right. But when you actually disaggregate the revenue, you realize that consolidated 10% top-line growth is kind of a statistical illusion.
It really is.
It masks a massive divergence. We are essentially looking at a holding company where one brand is acting as a rocket booster and the other is basically an anchor.
Yeah, the consolidation on the balance sheet is hiding the most aggressive brand polarization in modern retail right now. AEO is a tale of two entirely different growth trajectories.
Okay, let's focus on the rocket booster first, which is Aerie and its activewear spinoff, Offline by Aerie.
Right.
The numbers coming out of this division are honestly almost difficult to contextualize against the broader apparel market. I mean, total sales up 34%.
Yeah.
Comps up 25%.
It's staggering.
Yeah, we are not talking about a micro brand experiencing a brief viral spike here.
Yeah.
Aerie just crossed $2 billion in revenue on a trailing 12-month basis.
Hitting a $2 billion run rate while accelerating your top-line growth into the mid-30s, that is a structural anomaly.
It really is.
To grow at that velocity, at that kind of scale, it means you're not just acquiring new customers, you are fundamentally altering the purchase frequency and the basket size of your existing cohort. And Mike Mathias actually confirmed exactly that in the Q&A, traffic is up, conversion is up, AUR is up, and average order value is up. Every single KPI in the retail funnel is flashing green simultaneously for them.
And they added roughly 1 million new customers to the file, right?
1 million new customers.
I really want to break down the mechanism of that average order value growth too, because management used a phrase that I think explains the entire Aerie phenomenon.
Oh, the candy shop comment.
Yes. They called the store environment a candy shop. And they heavily emphasized their head-to-toe outfitting strategy.
Right.
Because this isn't just about selling a great pair of cotton underwear anymore. They have built an ecosystem lock-in. It honestly operates almost like a consumer hardware ecosystem.
That's a great comparison.
Right. You don't just buy the intimates. The merchandising practically mandates that you also buy the matching sleep shorts and, the oversized fleece that coordinates with it perfectly. They are manufacturing complementary demand within the exact same footprint.
It is brilliant cross-category architecture because historically, intimates brands really struggled to break out of the top drawer replacement cycle.
Like you just buy a bra when you need a new bra.
Exactly. But by blending intimates, sleepwear, and activewear into a single cohesive color and fabrication story, they transition the customer's mindset from a replacement purchase to a full wardrobe purchase.
Oh, that makes sense.
Yeah, if the customer comes in for the cotton undies, which, by the way, they noted had a record-setting performance, the visual merchandising just seamlessly pulls them over to the fleece rack.
Right.
The basket size expands organically without them needing to throw a discount at you to incentivize the add-on item.
And that organic demand generation, it's being fueled by a marketing engine that seems to be operating on a completely different frequency than anyone else in the space right now.
Oh, for sure.
The 100% Real campaign they did featuring Pamela Anderson is a fascinating case study. Because think about it. In a quarter where every other corporate executive on earth was trying to shoehorn the phrase artificial intelligence into their earnings script.
Oh, yeah, everyone is doing that.
Right. But Aerie took the exact opposite stance. They made a definitive public pledge to never use AI-generated bodies and to completely reject digital airbrushing.
What's fascinating here is that it's a phenomenal example of reading the cultural macroeconomic room.
Right.
We are entering an era of really deep consumer skepticism. The digital landscape is just totally saturated with hyper-optimized, AI-generated synthetic reality.
You literally can't tell what's real anymore.
Exactly. And the fatigue with that aesthetic is palpable, especially within Aerie's core Gen Z and millennial demographic. So by planting a flag in unvarnished reality and, utilizing a figure like Pamela Anderson, who has her own highly publicized narrative of reclaiming her unedited image, they aren't just selling clothes.
No, they're selling a value alignment.
Exactly. They're selling authenticity.
It creates a massive emotional moat. And they operationalize that moat almost immediately with the Aerie Real Makers influencer program.
Right.
On the call, they noted they blew past their 6-month target for that program in just a matter of weeks. They are totally bypassing the traditional, highly polished celebrity endorsement model and just weaponizing their own customer base as performance marketers.
Yeah, and when the customer truly believes the brand reflects their actual physical reality, they become the absolute most efficient customer acquisition channel you can build.
Totally. And we also cannot overlook the strategic positioning of Offline within this whole ecosystem.
The activewear line.
Yeah, they stated Offline is already the #2 legging brand within their core demographic.
Which is crazy when you think about it.
It really is, because the activewear space is notoriously crowded. It's dominated by these behemoths with massive R&D budgets. But offline is capturing market share, not by competing on elite athletic performance, but by competing on aesthetic cohesion and comfort.
Right. They are leaning heavy into matching sets and curated drops. They are essentially treating activewear as casual lifestyle apparel, which perfectly aligns with the current macro shift in how this demographic actually dresses day to day.
Okay, so Aerie is executing flawlessly. Product cohesion, cultural resonance, expanding AUR, they're just putting massive points on the board.
Yep.
But then we have to look at the namesake brand, American Eagle, the legacy core of the company.
Anchor.
Exactly. While Aerie is soaring at 34%, the American Eagle brand posted a total sales decline of 2%, with comps also negative 2%. So in a quarter where the holding company is basically printing money, the flagship brand is contracting.
Yeah, it's the dark spot on the print for sure. And it really requires a forensic look because the namesake brand still carries a massive physical footprint and it has a deeply entrenched customer file.
Right.
But to management's credit, they didn't really try to obscure the source of the bleeding. They were incredibly direct. The miss was concentrated almost entirely in women's bottoms.
Which is just devastating.
Yeah.
I mean, if you are American Eagle, denim is not a subcategory.
No.
It is your identity. If you miss on women's denim, you don't just lose the sale with the jeans. You lose the attachment sale of the graphic tee, the sweater, the accessories.
The whole basket.
The entire basket evaporates because the anchor product wasn't there. But I really want to scrutinize why they missed. Management's exact phrasing was that they failed to, quote, distort into specific styles and fits.
Right.
What is the actual operational failure behind that Wall Street jargon?
Okay, so in the architecture of retail buying, distorting means placing an asymmetrical, highly concentrated bet on a specific silhouette or trend.
Yeah, okay.
And the denim cycle right now is undergoing a pretty violent shift. We're moving aggressively away from the high-stretch, skinny silhouettes that basically dominated the last decade and moving into wide-leg, low-rise, puddle hem, and more rigid fabrications.
Right, the baggy look is back.
Exactly. And when a trend shift of that magnitude happens, a merchant cannot buy a little bit of everything. You cannot hedge your bets.
Because then you don't have enough of the winner.
Right. You have to distort your open-to-buy dollars heavily into the new silhouette, ensuring it dominates the floor presentation and the depth of your inventory in the stockroom.
So they essentially saw the trend coming.
Yeah.
I mean, they had the wide leg, they had the lower rises, but they just didn't have the conviction to back up the truck and buy the volume.
Yep.
They spread their capital too thin across the legacy fits and the new fits. And then when the customer walked in, specifically wanting the new fit, they were just out of stock in her size.
Exactly. There was actually a phenomenal moment during the analyst Q&A that perfectly crystallized this execution failure.
Oh, yeah.
Yeah, an analyst from Retail Tracker got on the line and specifically pointed out this low-rise drapey jean with orange flowers on it that's currently sitting in AE stores. She explicitly told management, you need like 200 more pair per store.
Wow.
Right. That is the textbook definition of under-inventorying a winner. They nailed the fashion red, but their merchandising depth was completely misaligned with the actual demand curve.
And then you compound an inventory depth error with a macro weather event.
Ah, yes. The weather.
Right. They cited a colder than expected spring, which they say froze the wear now categories, specifically shorts. Now, I am always inherently skeptical when management blames the weather.
Me too.
It's basically the oldest excuse in the retail playbook. We would have made our numbers, but it rained. So I push back on that. Is the weather excuse actually valid here? Or is it just a smokescreen for the broader denim architecture failure?
Well, it is a valid secondary headwind, but it is definitely not the root cause.
Okay.
Because when spring stays unseasonably cold into April, the transition from rigid denim into shorts gets delayed. The customer simply defers the purchase.
Right, they don't need shorts yet.
Exactly.
Yeah.
And management noted that going into Memorial Day weekend, as the weather finally broke, they saw a massive inflection in the shorts business. So the demand wasn't destroyed, it was just deferred.
I see.
But the weather deferral only exacerbated the core problem because when the customer did want long bottoms during that cold spring, AE didn't have the specific wide leg denim fits she was actually looking for.
So it's just a compounding penalty.
Exactly.
But it is vital to point out to the listener that the American Eagle brand isn't fundamentally broken at the brand equity level.
No, not at all.
Right. Because the men's business actually posted its third consecutive quarter of positive performance. Tops and bottoms both grew. And even on the women's side, the tops business, the fashion tees, showed incredible momentum.
Yep.
The total customer file for the holding company expanded by 3% to over 19 million. So the customer hasn't actually abandoned the American Eagle storefront.
No, she walked in, bought a top, but left the jeans on the rack because her size and the wide leg just wasn't there.
Which completely shifts the thesis on the namesake brand. This is an execution error. It's an inventory math error, not a terminal brand crisis.
Right. The brand equity is totally intact. The traffic is there. They just miscalculated the depth of the buy. And in modern retail, an inventory depth error is a fixable problem if your supply chain is agile enough.
Which brings us perfectly to the operational pivot and the guidance for Q2 and beyond.
Yeah.
Because management was adamant that they are aggressively course-correcting this bottoms architecture right now.
Yeah, we are.
They're leaning heavily on their chase capabilities to fix the floor presentation for the back half of the year. So unpack chase for me. In an industry where lead times historically run, 6 to 9 months from factory floor to retail floor, how do you fix a massive denim inventory hole mid-season?
It's a great question. Because chase capabilities essentially define the winners and losers in modern apparel right now.
Right.
Historically, a buyer commits 100% of their capital up front. If they miss the trend, they are stuck with it. But a highly agile retailer utilizes a read and react supply chain.
Okay, how does that work?
They commit perhaps 60 or 70% of their open to buy dollars off front to secure baseline inventory. Then they hold the remaining 30% in reserve. And they use fabric platforming, meaning they pre-position raw, undyed denim fabric at the factories. So when they see that orange flowered grapey jean exploding in week 1 of the quarter, they immediately trigger the reserve capital, tell the factory to cut and dye that pre-positioned fabric into the winning silhouette, and air freight it straight to the DCs.
Wow. So it collapses the lead time from 9 months down to potentially just 6 or 8 weeks.
Exactly.
They're trying to catch the falling knife before the critical Q3 back to school season.
Yep.
But before we get to Q3, we have to navigate the Q2 guidance. Because the numbers the CFO laid out are incredibly nuanced. Consolidated comps are guided mid to high single digits. Aerie is expected to remain in the high teens or low 20s. And American Eagle is guided flat to slightly negative. But the operating income guidance is where the math gets really complicated. They guided $45 to $50 million, but buried in that number is a massive external headwind.
Yes, the tariff situation. Management explicitly warned that the Q2 operating income guide includes a $20 million incremental tariff headwind compared to the same period last year.
$20 million straight off the operating profit line. Let's dig into the mechanics of this because it radically distorts the balance sheet.
It really does.
If you look at AEO's consolidated ending inventory at cost, it was up 27%.
Yeah.
Now, to any algorithmic trading model, a 27% spike in inventory cost against 10% revenue growth triggers an immediate sell signal.
Oh, instantly. It looks like a catastrophic inventory glut.
Exactly. But Matthias clarified that the actual units of clothing, the physical volume of garments sitting in the warehouses, was only up 5%.
Right, and that disparity between cost and unit volume is entirely driven by the macroeconomic and geopolitical environment.
Because the inventory itself is healthy.
Totally healthy. A 5% unit increase against an 8% comp growth is incredibly tight inventory management.
Yeah.
But the value of that inventory on the books has skyrocketed because the cost to import it has just surged. Matthias noted that the tariff rate on imports is modeled at 10% for the second quarter and 15% for the balance of the year.
Wow.
Yeah. So this specific dynamic is generating a 150 to 200 basis point drag on their gross margin right now.
It is a massive friction point. They are fighting tooth and nail for basis points of margin on the floor and then just giving hundreds of basis points back in the
Just throw it all.
Here's where it gets really interesting, though, because this is where the earnings call took a hard turn from standard operational guidance into absolute high-stakes corporate finance.
Oh, this was my favorite part.
Right. During the Q&A, an analyst asked a highly technical question regarding the monetization of a tariff claim. And the answer the CFO provided revealed an astonishing asset sitting completely off the balance sheet.
It was the most significant revelation of the entire call, and it was literally buried in the back half of the Q&A.
Right. So to understand what he revealed, you really have to understand how corporate tariff litigation works.
Yeah. So when Section 301 tariffs or other trade penalties are levied, the harmonized tariff schedule the HTS codes use to classify every single garment becomes a battlefield.
Okay.
A retailer might import a specific type of synthetic fleece, and Customs and Border Protection classifies it under a code carrying a 25% tariff. But the retailer's trade lawyers argue it actually belongs under a different code with only a 5% tariff.
So the retailer pays the 25% upfront just to get the goods off the dock, but immediately files legal protest to reclaim the difference.
Exactly.
And this litigation can drag on for years and years through the Court of International Trade.
Oh, for sure. And Matthias just casually dropped the fact that AEO has applied for roughly $190 million in these historical tariff refunds.
$190 million. For context, their entire operating income for this quarter was $28 million.
Yeah.
The scope of this claim is massive.
And it is not just a theoretical legal claim either. They have already started monetizing it. He confirmed they have received over $100 million of that money back already.
Wow.
Furthermore, earlier this year, they engaged in the secondary market for these claims. They sold a portion of their pending claims, roughly $70 million face value, to a third party in exchange for an immediate $20 million cash injection.
Let me stop you there. Because selling $70 million of claims for $20 million cash represents a massive discount.
It does.
It implies they took a significant haircut on the face value. So why would a CFO with a relatively healthy balance sheet accept pennies on the dollar to monetize a claim early?
It basically comes down to the time value of money and the inherent risk of federal litigation.
Okay.
Because even if your trade lawyers are highly confident, there is always a non-zero risk that the government prevails or that the appeals process just drags out until 2030. By offloading a trainer of that risk to a secondary distressed asset buyer, AEO secures immediate unencumbered liquidity. They can deploy that $20 million today into the Phoenix DC or into Aerie marketing and generate a guaranteed return on invested capital that vastly outperforms waiting 5 years for the government to maybe cut a check.
That makes a lot of sense. It's risk mitigation.
Yeah.
But even with that haircut, when you net out the cash already received, the claims sold, and the claims still pending, AEO anticipates a total net cash benefit of approximately $140 million.
Yep.
$140 million of pure cash flowing back into the business. And here is the absolute picker. Matthias explicitly stated, none of that is in our guidance. The $45 to $50 million does not include any benefit from that.
And that is the crux of the investment thesis.
Right.
Wall Street consensus models, the algorithms that drive daily trading volume, they operate almost exclusively on management's official forward guidance. The market is pricing AEO based on a $50 million operating income quarter.
Which means it is fundamentally blind to a $140 million cash catalyst that is virtually guaranteed to hit the balance sheet over the coming quarters.
Exactly. It is a profound structural margin of safety.
It just gives management unlimited optionality. They can use that $140 million to issue a special dividend. They can aggressively accelerate their share repurchase program, which, by the way, they are already executing, having bought back 3 million shares for $53 million this quarter.
Yep.
Or they can weaponize that capital to aggressively expand Aerie's physical footprint without dragging down the core operating margins. It is basically house money.
It is. Which brings us to the synthesis of all these moving parts. We have the margin expansion, the Aerie hypergrowth, the American Eagle inventory miss, the agile supply chain chase, the tariff headwinds, and finally, this $140 million hidden cash buffer.
This is where we distill it down to the talk tickers verdict. We have broken down the mechanics. We've stripped away the noise. For the retail investors staring at the AEO ticker right now, how do we weight these competing narratives?
Yeah.
What is the actionable stance?
Well, our stance, based on the fundamental architecture of this print, is cautiously bullish.
Okay.
And the weighting is heavily skewed toward the structural permanence of Aerie's momentum versus the transient nature of the American Eagle miss.
Yeah, I am completely aligned with the bullishness on Aerie. You just do not accidentally compound a $2 billion brand at a 34% growth rate.
No, you don't.
The head-to-toe ecosystem is sticky. The AUR expansion proves they have legitimate pricing power. I mean, the consumer is happily paying full retail because the cultural resonance of the 100% Real platform is so strong, they have fundamentally decoupled from the legacy mall promotional race to the bottom.
Exactly. And the caution entirely resides with the namesake brand.
Yeah.
Because a 2% decline in your core cash cow brand is a red flag that demands monitoring.
Totally.
But the reason it doesn't break the bull thesis is because we understand why it happened. This wasn't a systemic rejection of the brand identity. The customer traffic was positive. The men's business is thriving. The women's tops are moving. This was a highly isolated, specific merchandising failure in women's denim depth. They simply underbought the wide leg trend. That is just a math problem.
And a math problem is solvable, especially when you have the chase capabilities we discussed earlier.
Yep.
Management is not blind to the orange flower jeans sitting out of stock. They are pulling every supply chain lever available to flood the floor with the correct architecture, which gives us the exact catalyst to watch for you holding the stock. Management literally referred to Q3 as their Super Bowl.
Because in teen and young adult retail, Q3 is everything. Back to school is the primary denim replenishment cycle for that entire demographic.
Right.
If American Eagle is going to prove they fixed the inventory math, they have to prove it in August and September.
So here is the scenario you need to model as an investor. We already know Aerie is a runaway freight train. If Aerie just maintains its altitude, even decelerating slightly into the high single-digit or low double-digit range, it just continues to print cash.
Yep.
The massive leverage in this stock lies entirely with the American Eagle brand simply stopping the bleeding. American Eagle does not need to post heroic 10% comps. If they just use their chase capabilities to get the right wide leg denim on the floor for back to school and return to flat or positive 1% comp growth.
The combined leverage of those two brands operating effectively at the same time will be explosive.
Totally.
The top-line recovery in AE, layered over the massive BOW leverage from the Phoenix DC, layered over the sustained high-margin pricing power of Aerie. And remember, as we move into the back half of the year, they begin lapping the worst of the tariff hits.
Right.
The operating margin expansion could be really violent to the upside.
And sitting underneath all of that operational leverage is a $140 million cushion of off-balance sheet cash just waiting to be deployed. The downside risk is heavily insulated by that tariff refund, while the upside is primed by an impending denim correction in Q3. It is a classic asymmetric retail turnaround setup. The operational pain is priced into the Q2 guidance, the structural fixes are in motion, and the true assets are off the radar.
It requires some patience through the Q2 transition, but the fundamental mechanics are highly compelling.
Right. That concludes our deep dive into the underlying architecture of American Eagle Outfitters Q1 2026. We hope this breakdown of supply chain agility, margin dynamics, and hidden balance sheet assets gives you a much clearer lens through which to view this ticker.
But before we close the book on this quarter, there's one final overarching concept that emerged from this call that really demands reflection.
Okay.
It is a concept that extends far beyond AEO and challenges how we evaluate the entire legacy retail sector.
I know exactly what you were going to point out. It's the origin story.
Precisely. The CEO made a comment that is easy to gloss over, but it is structurally profound. Aerie, this absolute juggernaut, this $2 billion brand growing at 34%, was not an acquisition.
Right.
AEO did not deploy billions of dollars in M&A capital to buy a trendy upstart and bolt it onto their P&L. They incubated Aerie entirely from scratch, internally, starting roughly a decade ago.
Wow.
They identified a white space in the intimates market, seeded the concept, nurtured it through the awkward growth phases, and compounded it into an industry-defining powerhouse.
They basically built a $2 billion unicorn inside a legacy mall retailer.
They did, and it forces a radical reevaluation of how we look at other legacy tickers, because the market loves to assign terminal decay multiples to older retail holding companies, just writing them off as dinosaurs burdened by mall leases.
Yeah, that happens all the time.
But it begs the question, as you look across your portfolio, scanning those unglamorous, overlooked legacy brands, how many of them are quietly using their core cash flow to secretly incubate the next $2 billion category killer, completely under Wall Street's radar?
That is a massive signal hiding in plain sight. Happy hunting, everyone.